Hey everybody, today we're going to go over what is bearish divergence in the markets, what indicators can you see bearish divergence on, and what are the most common misconceptions about bearish divergence, also known as negative divergence. So first things first, as always, anything in the market is really based on probabilities. You can have bearish divergence last for a very long time. You can have any type of setup fail that is generally a statistically bullish setup. For example, if you're looking at an ascending triangle, generally that's statistically bullish, but that doesn't necessarily mean that you're always going to go up. Just like in bearish divergence setups, you're not always going to go down. And really, how far you go down is really a function of different tiers of price action hitting different triggers. So for example, if you have a move down from bearish divergence, you have your initial target, and then you reevaluate from there and wait for your next trigger. So to really answer the first question, what is bearish divergence? It's very, very simple. It's really when price is moving up and closing higher, and that's a big thing that I want to focus on here is if you're using any indicator for bearish divergence, most of these indicators are a function of the actual close of the candle. So just because you have a higher high, but you don't actually close higher than a specific point on the chart, that's not technically divergence. Divergence is when you have actual closes that are higher highs and then closes on an oscillator or any type of indicator that really oscillates between two different points, really having lower highs. So in this case, you can see here that technically we have had bearish divergence on, we're looking at the RSI right here, for quite some time, pretty much since December of 2023. So what is the problem with this? Well, we continue to go up. So if you were to really use simply just the fact that we've been hitting lower highs, and so if we want to start from the first lower high here, so this is a high from December 18th. So if you then want to put your line here pretty much at December 18th, that would be here. And then you want to connect it to this lower high here. Then you can essentially see that, yes, we did get a pullback for one day. And then 2 days later, we hit a new high. So you really have to use some type of price trigger for the next move down. And really, you can't just use divergence only simply looking at the price if it's got a higher high and the indicator has a lower high. You really have to use price triggers as well. So you can have divergence last a very long time. Notice here, we once again have this high to this high. So we once again have a lower high here. So if we were to move this up, pretty much here to around here, and you can see here that, once again, technically, we did have a little bit of a pullback. It was one day. Now, doesn't always have to happen like that. Many times you will have multi-candle moves to the downside when you do finally have divergence, but as I mentioned, you really have to look for some type of trigger. So as we'll continue to go on, we once again have a lower high here. However, we have essentially another higher high. So the question is does bearish divergence even work? And it really depends on what type of market you're in. If you're in a bull market like the market has been in pretty much since the lows in October, then generally you need to really focus on some type of trend guide as well. Generally, those are moving averages. So for example, if you're using moving averages, the 20, the 50, the 200, and they are sloping to the upside and moving to the upside, you are in an uptrend. And so pretty much instead of really just trying to time the next market crash, you really can use these divergences as very short-term kind of inefficiencies in the market that really kind of correct themselves very quickly. As you can see here, each time we've had these lower highs here with a higher high on price, we only had a 1 or 2 day move down. And so, for example, if we zoom in here, this is where we can go over, what would be a price trigger. So if we zoom in, and one thing I wanted to point out here is the fact that we have the MACD, which is also an indicator that you can use divergence on. Pretty much the MACD line, the pivots here of the MACD are lower highs, higher closes on price. And so you can really use this on, as I mentioned, any indicator that really oscillates. But you can also use it on balance volume. You can use it on a number of things. So pretty much anytime you have any indicator that can print a lower high while price is printing a higher high, you can have divergence. And so in this case, let's just kind of focus on the RSI here and look at what would be really a trigger here for a bigger move to the downside. Because as I mentioned, you can have divergence last a very long time. If you look back at what's happened in the market, if you were just playing the divergence and let's say adding on every time you had a new high, you would have blown your account weeks or months ago. So these divergences can last a very long time, and that's the thing. And same thing with positive divergence or bullish divergence. You can have a stock continuing to move lower even though the indicator is printing higher lows. And so positive divergence, bullish divergence is the opposite of bearish divergence, which, as I mentioned, is really just lower closes on price, higher lows on the indicator. But as we can see here with the current market, opposite of what we're seeing now, you can see and you can pretty much observe a stock continuing to move lower and lower as you still have this divergence, which, especially if you're trading something that's highly leveraged or trading on a longer time scale and you don't have a lot of time to be right, that is really a recipe for disaster. So waiting for the price trigger is really important. So in this case, if we wanted to look for a potential price trigger on MES, so the micros for the S&P, we could really just do this. So let's zoom in here. We have definitely the higher closes here, pretty much starting here. So here's your higher closes. That's essentially what this ascending line is essentially the is showing the higher closes. And then the downward sloping line here, pretty much from, this is February 8th to this point here, February 29th, that is your lower close. Now, what would be the price trigger? Well, everybody has their own type of trigger, right? So if you're a horizontal level trader, your trigger would simply just be a daily close below this area. Now, this is all based on time frame, right? You can use divergence on any time frame. You can use it on the daily, the weekly, the monthly, the 5-minute. And so what you really need, though, is you need that trigger. So different types of traders will use different triggers. In this case, if you are more of a horizontal, just basic support and resistance trader, you would likely wait for a close below the bottom of this zone. And so what I'm doing here is I'm essentially, for this zone, I'm taking the wick here of this candle and essentially just connecting it with the body of this candle. So you have a zone, and you can see instead of just really a couple points, you've got multiple points here. So a close below this area would be very important and kind of a change in the status quo. So one, if you're a horizontal trader, you can definitely wait for the close below. If you're more of a VWAP trader, you can definitely use the anchored VWAP as your potential trigger. So in this case, if you're using the anchored VWAP, it would be a little bit of a different close, a little bit of a different trigger here. So you would really want to wait for a daily close below the VWAP. In this case, that's right around 50.87 currently on the micros chart that I'm looking at. And so this is really where it becomes more of a science rather than just, hey, I'm just going to look for any time that price is trading at a higher close and a lower close on the indicator. The big thing that people miss and the big mistake people make is not waiting for an actual trigger, because you can have these divergences play out forever. but you really want to wait for a candle close below whatever your trigger is to establish the next downside move. So in this case, if we were to use the anchored VWAP as our trigger and we wanted to essentially use this diagonal trend zone as our downside target, you would essentially wait for a break and close if you wanted to use maybe an intraday close. And your swing trading, that's one thing. But one thing I'll point out here is if you're doing an intraday close, then and you're not waiting for an actual daily close, you can have false signals here as well, because notice what happened. We broke down below this area and then we bounced right up the next day. So it really depends on what time frame you're trading. If you are trading a daily candle chart, you really want to wait for the actual daily candle to close below the VWAP or below the horizontal level that you're watching to really get a higher conviction setup and probability of potentially this trade playing out. So you'd simply wait for a daily close below this area. And then if you're, let's say, using this basic diagonal trend zone as your downside target, you then would wait for price to move down to this area. And then you could either reevaluate there, maybe cover your position to the downside, or after the downside move happened, you cover your position to exit the trade, or you wait and see if this particular level holds. It is sometimes pretty hard to make an actual trade off of a diagonal trend zone because they change pretty much each day. The slope of the diagonal trend zone essentially is changing the price on a candle by candle basis. So that's why a lot of people use horizontal levels instead of diagonal levels, because horizontal levels are static, diagonal trend zones are not. They're constantly changing. But either way, whatever your downside target is, you just have to make sure that you are using a trigger. So all in all, that's really an overview of what bearish divergence is. Bearish divergence is really when you have higher candle closes, whether that's a daily, whether that's a weekly, whether that's a 5-minute candle, and the indicator is having lower highs while you are having higher closes on price. Divergence can last a very long time, so simply just looking at divergence instead of using divergence with some type of price trigger definitely can give you a lot of false signals and put you in a pretty bad spot in a trade. So definitely you want to use these price triggers, and the price trigger is really a function of if you're a VWAP trader, maybe you're a moving trader, you're waiting for the price to close below a specific moving average. But whatever it is, the price trigger is just as important as being able to identify the divergence. And then from there, picking your target can simply be a VWAP below, a horizontal level below, a diagonal level below. And so that is really up to the individual trader. But all in all, this is how you can really look for bearish divergence, also known as negative divergence, in the markets. If you like and enjoy these videos, definitely check out the other educational videos that I've created. There's a ton of educational videos on the Optimus Futures educational video list and the YouTube channel in general. And if you do like these, please like and subscribe, and definitely check out the future videos that I will be making.